Recently, we've been hearing a lot of chatter about the crypto market being highly correlated with the stock market. And your first response when you're hearing such a claim should be, oh, really now? And the second question should be, well, if it is correlated, how long has it been correlated? Has it always been correlated? So how do we answer that? I mean, we could look at a chart here. Look at a Bitcoin chart. It's trading at 35,900 and change. And we've got the stock market trading at 4,100 and change. Well, they're quite different from each other. And how do we compare that? And again, even if we get these numbers in line, well, how do we compare it? Right? I mean, by what means? Well, with that, I introduce you to the glamorous world of hypothesis testing. Because that's really what's going on here. We have a hypothesis. We are saying, or somebody's saying, the stock market is correlated with the crypto market. Well, there must be a way to prove that. And yes, there is. And with that, I introduce you to the concept of p-value. With p-value, we can prove whether or not there is actually correlation. But what is p-value? Well, it has nothing to do with urination. And it has nothing to do with any bathroom activities, in fact. It actually stands for peculiarity. In a way, that's a way to think about it, right? That's the paradigm. P-value means, how peculiar is this? And it's best explained by example. So let's say we have a coin. And the question here is this a trick coin? Well, that is the hypothesis. Is this a trick coin or is this a fair coin? Well, in order to test this, we have two scenarios, right? Ho and ha. Ho and ha, right? Well, H0, HA. And ho is, well, nothing's gone. That's the boring hypothesis. It's a fair value coin. It's just a normal coin. Ha, well, that's the hypothesis. That is what we're trying to prove. And in this case, well, if this is not a fair coin, well, then there's some trickery going on. Right? With some trickery going on, it's most likely a trick coin. So if I go, take this coin, whoops. Oh, tails. Okay. Here we go. We have one observation, one tail. And the possibilities here are two. Right? We have two possibilities. Now, we've done it once, so we have two possibilities. It was either tails or it was heads. Heads or tails. Tails or heads. So we have two possibilities. So what are probabilities of either happening? Well, it's very simple. It's basically 1 divided by this. So we have 0.5% probability. And you come to me and say, this proves nothing. Any coin, you do it once, probability is high, 50-50. You'll land or either on heads or tails. Okay, let's do it again. It's tails again. All right, tails again. All right, two tails. How many possibilities do we have here? Well, 4 possibilities, right? First time it was either heads, or it was tails, or it was then tails, or it was then head. Right? So we have 4 scenarios here. Hey guys, Mike from the future here. Actually, this guy didn't know what he's talking about. The first scenario is both would have been heads. Second scenario, both would have been tails. Third scenario would have been, first would have been tails, second one heads. 4 scenarios, first one would have been heads, second tails. Which means, if we drag this down here, the probability of this landing again, this coin, landing again on tails, was 1/4, right? 0.25. That's the probability here. Well, that's not very unusual either. It happens all the time, right? Okay, let's continue. Let's do it again. What do you know? It's tails again. All right, 3 tails. Okay, well, in this case, we would have 8 possible scenarios, right? Keeps doubling all the time. And the probabilities here is now 0.125. And that's still 12% if we're doing a percentage basis, right? 12%, it happens. It happens. It could still be a fair coin. Okay, all right, let's do it again. What do you know? It's tails again. All right, 4 tails. Oh my God. And at that point, if you explain this to people, people are starting to think, like, I mean, at this point, we're basically down to 6th percentile. And the odds of this happening, it's less plausible. It's starting to be a little bit peculiar, right? Okay, let's do it one more time. Boom. Ha! What do you know? It's tails again. All right, 5 tails now. Well, in this case, we're down to 3%. 3 percentile. And you're thinking, at this point, like, see the hands coming up, and I'm like, I think this could be a fake coin. Could be some trickery going on. Well, let's keep going on. Let's do it one more time. Okay? One more time. One more time. Ah! You wouldn't guess it. It's tails again. I mean, we're talking 1 out of 64 here, right? And the odds of that happening are 1.5%. At that point, the question you got to ask yourself, right, is where do you draw the line? Where do you draw the line where you go from possible to there's some trickery going on here. This is highly implausible. This is very peculiar, right? And hence comes the p-value. And normally where people draw the line is below 0.5, right? Somewhere below 0.05, which is 5%, the 5 percentile. There's basically one test that we're going to look at today, which is the Engle-Granger test. And I've prepared actually something to prove whether or not we have integration going on between stock market and the crypto market. And now that you understand what the p-value is, do we have enough confidence to rule out the null hypothesis? Because this is what this is, right? This is the null hypothesis. There's nothing going on here. It's the boring hypothesis. Is there trickery going on? And you would say that below 5%, 0.05, the probability is high enough for us to make that assumption. We can rule out the zero hypothesis. And we can say with confidence, whatever we're testing for, in this case it's trickery, right? It's plausible. We've reduced it down to 95 percentile, that there's some trickery going on, right? Because the odds of this happening is so small, right? It's below 5% of the cases. And this is where we draw the line. What we kind of starting, we never know. I mean, I never show this coin. You'll never know if this is a trick coin or not, right? It's not even a quarter, by the way, but it's a different story. But you get the idea. I'll never show this coin. Even if I have a quarter, you're never going to know. You just have to basically, based on observation, empirical observation here, form the hypothesis, and you need to prove it. And that's how you do it. And that's how it works in the real world. All kinds of, you will never know for sure. You need to test this. So in order to do so, prepared a little bit of a spreadsheet here. And, you don't have to be a coder. It doesn't really matter. All you have to do is really, what you need to know is that we're basically downloading data here for 2 symbols. One is Bitcoin against the USD, because that's what we're measuring against. And the other one is the spiders, right? Spiders is basically ETF based on the SPX index. And we're going to download that daily data, and we're going to plot it. So let's do it right now. We're doing this live. Hooray. And so what we have here, you can see Bitcoin USD, first column, right? And here we've got the spiders, all right? I'm going to show you something here. This is basically what I'm doing. I'm multiplying this column here by 80 because it's approximately the value necessary. You could, multiply 100 would still work the same. It's approximately the value of the spiders multiplied, so that you arrive to something close to what Bitcoin is, right? So in order to bring these two in alignment, you could either normalize them down to each, based on 100 somewhere, or you just multiply that one, which is the simpler way to do it, right? Take the smaller one, multiply it, bring it close enough. And what we're then doing after that, we just plot it, right? And you can see right here, that's what you get. Well, does it look highly correlated? Well, not really. What we have here below, and I've provided a little bit of an explanation here, is the Engle-Granger test for co-integration. And co-integration basically means, are they moving in tandem? And the actual test underneath the hood uses the augmented Dickey-Fuller test. You don't need to know what all that stands for. What you need to understand is the null hypothesis. Remember, the null hypothesis, the boring one for the Engle-Granger test is that no co-integration exists. The null hypothesis is written using standard hypothesis testing notation as, again, ho, ha, right? H0 and HA, or H1 often also used. So the boring scenario, the hypothesis that's really boring is no quant-integration exists at all. That's what we're trying to prove against. I don't know why it always does that. The alternate hypothesis, ha, right? The alternate hypothesis is that a series has quant-integration of some kind. So this is basically how we're going to run this. I'm using stats models, which is a math library from inside Python, and I'm running this right here. What we're actually going to look at is the 5 percentile. You can also look at the 1 percentile, which is a much stringent test, and there's also the 10 percentile, which is a less stringent test. But we're looking at the 5 percentile because that's commonly the one that's being used for p-value. You can do a p-value of 1% as well, but you're going to have a more stringent test because the probability has to be lower than 1%, right, for this to happen. So first thing we're looking at here, in order to Engle-Granger test to work, right, it gives you the critical values for 1%, 5%, and 10%. It also gives you t-statistics. That's a value it has arrived after you ran the test. And you need to basically correlate these two together. I have already written a little bit of code here to kind of spell it out, right? So our test statistic of minus 195. By the way, it's always a minus number, and I forgot to mention it. For this test, and it's the same actually for the Dickey-Fuller test, you're always going to get a negative number. Why? Don't ask me. You don't want to know, right? It's more complex math. And this number, whatever you've been given, the t-statistic, right, in this case, needs to be smaller than the negative values that you've been given by the critical values. In this case, we're looking at this one, critical value of 5%, of the 5 percentile. And so now we're getting to the exciting stuff. Our test statistic of minus 1.95 is larger, right, because it's a larger number, than the critical value of minus 3.34, which is this one here, at the 5% level. This means that we can not reject the null hypothesis. Remember? The boring hypothesis, there's nothing going on here, right? There's no co-integration. We cannot reject that with enough confidence. It means, and also just by looking at it, you can tell, but we proved it without a shadow of doubt. There was no co-integration going on if you consider the entire data set. Makes sense? Now, let's go step back a little bit. And we're going to run this again, but we're actually going to run it with less data because, okay, I've actually compared 2 years worth of data in order to run this test. It hasn't been integrated based on 2 years worth of data. Let's see if 1 year of data, if that suffices. We run it. Okay, we got less data now. Let's do the same thing again. We have to adjust it, right? And we're going to plot it. Okay, now we get less data. And you can see, okay, it moves a little bit in tandem, a little bit. But is it really highly correlated? Can we really say that these two markets move in tandem? All right, well, let's see what the numbers say. Right now, critical value is, again, 3.36% for the 5 percentile. And the t-statistic that we're getting from the Engle-Granger test is minus 2.93. And that means our test statistic of minus 2.93 is larger still than the critical value of minus 3.36 at the 5% level. And that still means that we cannot reject the null hypothesis. So the p-value is just not low enough. Okay, well, we're not done yet. We're not done yet. Bear with me. I'll make a little change here. Well prepared. And now we're going to look at 180 days worth of data. So about half a year worth of data. So it doesn't do it for 1 year. Maybe in the last year, and it actually has been correlated. All right. Same thing again. And let's plot it. All right. So we have less data than before. It looks more as if it's moving in tandem. So let's run the test and see what the test says. All right, t-statistic minus 3.33. Critical value of 5% is minus 3.38. Our test statistic of minus 3.3389 is larger than the critical value of minus 3.38 at the 5% level. That means we cannot reject the null hypothesis. Well, so still, right? Still, we cannot reject the null hypothesis. We still don't have enough evidence. Okay, one more time. So bear with me. Let's run it for 90 days. 90 days, okay? Same thing again. We're adjusting, plotting. All right, now we got But looks like, to me, I mean, if I look at this with my plain eyes, I see a little bit of correlation here, right? I mean, it moves a lot less, it swings a lot less, but the direction seems to be correlated, right? You would agree, okay? Well, let's run the test. Now what we got? T-statistic, minus 3.70. What is the critical value of 5%? It's minus 3.43, which means this number is actually more negative. And lo and behold, our test statistic of minus 3.7 is smaller than the critical value of minus 3.43 at the 5% level. This means that we're able to reject the null hypothesis of no integration. We are able to reject it, statistically speaking. So we don't have to ask anyone. We actually have proof now. And I think this is pretty freaking exciting. It's a bit worrisome too, but at least now we know. There is actually high correlation right now going on between these two markets. But it has not always been this way. And if you bear with me, maybe we can run one more test, okay? It didn't happen at 180 days. It happens at 90 days. So you want to run it one more time? 120, okay? Actually, I could write code that just kind of steps through in maybe 5 days intervals and then checks when the threshold occurs. But, well, let's just do it this way. Process of elimination, correct? Okay. All right. That's 120 days. Let's run the test one more time. Okay. Is larger, we cannot reject. So it happened somewhere between 90 and 120 days. That's when it really began in earnest. And we're fairly highly correlated at this point. You can say this with a 5% percentile. And we've proven it. As opposed to relying on other sources, as opposed to just believing what we've read, we've proven that there's a correlation going on. And, well, that can affect our trading. Actually, it will affect our trading significantly. And that also proves to us that the crypto market is always in flux. It's changing. But with this test, we can actually test whether or not there is correlation going on an ongoing basis. We can have a sliding window that we keep testing. I think 90 days is actually a great window. That's a good trading horizon. And with that, we can then establish, okay, whether or not we can actually use the stock market as a factor, as an alpha factor in our trading, saying, okay, in the stock market and the crypto market, there's similar moves going on. So we need to anticipate that. And we can look at other factors to maybe Federal Reserve making certain decisions to decide whether or not we're making certain investments or trading decisions. And I think that's extremely valuable.